back to the Mike Rosehart Show. We're live here again, like we are every Wednesday. And I still cannot get rid of this ugly, gross little beard that I have because I am still a little ways away from recovering from blowing up my entire account in, was it mid-July? I guess it was. So yeah, today let's talk about options trading. Let's talk about anything you guys want to talk about, throw it in the comments, but I titled today's video to be options trading. I love it. I think it's one of the best passive income strategies that exists. With real estate, you've got to put in significant amounts of time, but with options trading, you can spend like 5 minutes a day and have great results. So I'm going to talk a little bit about it on this episode now. So if you're joining late, then you just got to restart. If you're, this is the place where I'm starting here, about 1 minute mark. I'll explain, the basics of what the wheel strategy is. So I think an ideal portfolio is made up of about 50 to 100 stock positions, 50 being the minimum amount of different companies you want in your portfolio. You want to represent a vast number of sectors. Another way to do this is to just simply buy a number of indexes covering, like a world index, a Brazil, Russia, India, China index, of course, like the S&P 500, a SPY index. If you're Canadian, then obviously Canadian indexes as well. It's important, I think, to have that diversity and have no position, in any one sector or company represent more than 5 to 10% of your entire portfolio at any given time at a maximum. I made that mistake when I let the short, and don't short. The wheel does not involve shorting. I know I've talked about shorting on my channel before and the mistakes I've made doing it, but in an ideal world, running the wheel is this. You pick, let's say 50 companies that you love, and you put them on a watch list. And every day at about 9:30 in the morning, maybe about 2 in the afternoon, you check it twice a day for 2 minutes. You just scroll the list on, say, Yahoo Finance, and you look at these companies that you like. And you go in and you say, hey, what price am I comfortable buying these companies at? Maybe you say, I'd love to own, Canadian bank stocks. Pick one, Scotiabank, let's say, or Bank of Montreal. You're like, hey, you know what? At 80% of the current price, I would love to own them. And if you set you sell a put order, then you'd be able to agree to have BMO shares put in your account at a set price. And you can get paid an insurance premium for agreeing to buy BMO shares. And the more the stock is down or beat up that day, the more the premium is going to be. So let's say it's a down day in the market. Happens, at least once a month. We have a big 2% down day in the overall North American market, European market, whatever. On those days, you want to be loading up on contracts and agreeing to buy companies that you love. And so you say, hey, stock I love is trading at $100 right now. I would love to own it at 90. But you can't just go buy the shares at 90. So what do? You sell a put. You say, hey, I'm going to go sell a few contracts to agree to buy these shares at 90. Now, when the contracts expire, you may or may not, depending on the current price of the share, you may or may not get assigned those shares which you wanted to own in your portfolio. Now, 9 out of 10 of these contracts, if you're running them properly, expire with you getting no consequence of assignment. So you're not assigned any shares, and you continue to write contracts on a 1 month basis, let's say. So a month from now, you agree to take those shares on, right? So that's what selling puts is. You sell a put to get assigned the shares that you want. Once you've got the shares that you want, you then sell calls on those shares that you now own, covered calls. So covered call means you own the shares, you're selling a call in it. Naked meaning you wouldn't own the shares. So covered call in a wheel strategy would mean you're agreeing to now get rid of those shares. Let's say you got those shares in BMO, the example that I used, the Bank of Montreal. Let's say it was trading $100 a share, you sold puts at 90, it paid you $1 a share premium. So effectively, if you were to get assigned, let's say the current share price was 90, you'd be getting them for $89 a share because you got $1 premium. So you agreed to buy BMO shares if they dip on the expiration date of that contract. At any time during the contract, you could be assigned if the stocks dip. Now that's when you want to own. So you want to be selling puts at a price you're comfortable owning at. And the minute that you get assigned, that's when you go say, okay, now I own them at 90. I'd be okay getting rid of these shares for a 15% profit, which is like $103 a share. So you say, hey, I just got assigned at 90. I made $1 premium. That's awesome. That's a 2% annualized. Most of these contracts you're selling are between 2 and 4% annualized per month premium. So divide times that by 12 to get your annualized. So between 24 and 48% annualized, monthly of 2 to 4% typically. You will get assigned some of these companies, and that's okay. That's what you want. That, like, people get worried and they get afraid. You know, if you're really afraid, you could also just do a spread trade. So you could, you could buy a BMO put at like 95 and then sell one at 90. And if the current share price is 100, then if it goes between 85 and 90, you'll get assigned. But if it drops below 85, you're stopped out. You can't lose any more. You don't get assigned. You have a max loss defined. That's the nice thing too, is that you can set max stops for, stop gain, stop loss. That's really nice too with options contracts. But the idea is you get assigned the shares that you love. You take the shares you now have, and you say, hey, what price am I comfortable selling them at? Maybe it's 10, 20%, premium from now. You start selling calls on them. And now these calls are generated. You're owning your shares. You're collecting your 6, 7% annualized dividend. You're using leverage. And now you're selling calls to get rid of your shares. That's free 1 to 2% a month income on the shares you already own. You're now getting cash flow from the shares you own. So when you've now got the shares at a discount, when you sell a put on a company that you want to buy, even if you sell the put at current share price, you'd get a discount. That's just how it works. You get a discount for agreeing to insure to buy those shares. So if you're going to let's say you love Tesla and you want to buy Tesla right now, why not just sell a contract for November 19th that says, on November 19th, I'll agree to buy Tesla at $1,000 a share, whatever the current share price is, $1,200 a share right now. You could do that, and you probably get paid like $60 a share just to agree to buy the shares in a few days, because you're taking the risk of having to buy those shares. But if you want to buy the shares anyway, why not sell the put and get money for nothing? That's what selling puts is all about. The other side of puts is someone else is on the other side of that contract is buying a put, right? And they're buying put because they want to protect the equity that they have. Maybe they have shares of Tesla and they're afraid that they'll drop and they want to protect their profit. So they're going to give a percentage of their profit away to you to agree if the shares drop, they can put them in your account. So options, super, super simple once you wrap your head around what a put is and what a call is. Call is your shares get called away. Put is they get put into your account, or you can put them into someone else's account. So call is like, hey, I'm going to call you up and I want the shares. So if you sell a call, someone's going to call you. They want the shares. And if you're short, you don't have the shares to give them, you'd be short the shares. That's where the term, being short is. That'd be called a bear call, right? Super basic. Like in one day, you could wrap your head around, there's only like 4 ways you can, there's multiple permutations of the 4 ways you could engage in a put or a call, but you could buy a put, sell a put, buy a call, sell a call. You could do spread trades, which is basically just, it could be one where you're, buying and selling a put at the same time with a spread of profit in between. So let's say you're doing it at 100 and then one at 90. It's the same stock. You're buying and selling a put to protect yourself. Same thing with calls. You could be in the short, bear position or in the bull position, in which case you'd be, it just depends on your strategy you're trying to employ. But I think it's great because you can get money for nothing. It's the same as buying the equity. You're agreeing to buy in at a future date. So let's say like you love Tesla, but you're like, you know what? I love Tesla like $900 a share. Cool. Don't buy the equity, but you can start selling puts on that. And if it ever drops to $900, guess what? You can get the shares. You can go buy them. You now have a contract to go buy them at that price. And if it doesn't, it stays above that price, you get money for nothing. They'll pay you 1 to 2% a month for agreeing at a future date to buy the shares. You can do this with the S&P 500, the indexes, the VTI, the world index. All the indexes trade in the option market. There's an option market and derivative market that trades against all these indexes. So the S&P 500, it's an easy one. You could do, you could say, hey, every week you could do a weekly and say, hey, I agree to buy the S&P 500 if it drops below 400. And right now, the SPY is trading at like 460 or something, right? So you can say, hey, I'll agree to buy it if it drops like 15, 20%. In which case, like, that's typically a marker of a recession. That's when you want to buy anyway. So you'd be like, sweet, I'll just keep selling contracts when I'm comfortable buying. And you can now avoid buying any equities because you're saying, hey, it's overvalued. I feel like maybe there are people out there who come to me and say, hey, I can't buy any stocks, Mike. The whole market's overvalued. I'm like, okay. Like, why don't we, if you do believe that, why don't you set up a defined short of the market? Why don't you agree to sell calls and create a spread where if it drops even 10%, you get paid. If it drops 12%, you're stop lost, so you don't care. There's very little risk. You're betting that it's going to go down, but as long as it doesn't go down just a little, well, then you'd be short the SPY. And if it continues to go up, then I guess you'd be short. So you want to close that contract out. But if you do believe that, you could create a sort of insurance contract around that. So that's what I love anyway about options trading, and what I love about using options contracts to build a healthy portfolio. I've had, if you subtract the two large positions I got into that tanked my portfolio, I did some shorting, which resulted in me losing $1.55 million in one day. If you negate that, the other 1,000 trades I've done, because I do, I typically trade 20 to 30 contracts per trading day. So I'm active with 50 to 100 different companies. I got into one really bad position. I made a big mistake. I let it take over almost half of my entire portfolio, and then it tanked in the inverse. So I got margin called and squeezed. Not something I recommend. Like, stick to the basics. No position more than 2 to 3% of your entire portfolio. Build a quality portfolio of stocks. If you look at removing those two trades, I've been making between 4 and 5% a month. That's amazing. I've come back from decimating my entire portfolio. I'm $90,000 away from shaving. I lost $1.5 million. I've made that back without taking any wild risks, without engaging in crazy short behavior, just by simply running the wheel on quality companies, right? So I'm a big fan of options trading. It is, I think, a superior way to build a portfolio. If you have a portfolio of stocks already, you could go about looking at stuff that's overvalued and say, on those days where it's way up, and you're like, hey, this stock is like overvalued in my opinion. You could say, hey, I'm just going to sell calls I'm going to sell call contracts to someone who wants to buy calls, and say, hey, I'll sell these shares off at this price, and you'll get paid between 2 and 3, sometimes even 5%, depending how bullish the market is, on your current shares that you would have had to sell at market price. You get a premium for that. So instead of let's say your shares are overvalued, you want to sell them right now in the open market. There's no reason to ever buy or sell equities when you can use options to achieve the same thing. You can get paid to sell your shares tomorrow instead and get a premium for that. Or worst case scenario, if the stock goes back down, you get money for nothing. So that's kind of cool. I really like about options. So yeah, let's go to the Q&A and see what you guys are saying. Hey Jazz, how you doing? Eric, good to see you on. $50 minimum wage, more fuel on inflation. Yeah, I mean, here in Ontario, Doug Ford has announced, our premier in Ontario has announced that he's going to increase the minimum wage to $15 an hour Canadian. That is, I mean, we're already in like a hyperinflation environment. Here, the price of real estate's way out of hand. Our supply chain issues are way out of hand. Yeah, this is just pouring gas on the fire at this point. So, yeah, I mean, I don't know. At this point, I have no comment about, well, I have lots of comments, but I'm going to reserve my comments about the current government. They've just done a terrible job, and I could see myself moving away from Canada very soon, just for a number of other reasons too. But yeah, it's getting wild, guys. It really is. Next question was, how does a leap call work? So Jazz, a leap call typically, and I've heard a leap call mean more than 1 year, but typically it means a 1 year, it's you agreeing to buy a call option 1 year from now. So let's say, Tesla is trading at $1,200 a share right now, which is insane. I am bearish on the current price of Tesla. I like Tesla as a company. I love them. I love the growth trajectory they're on. They're just, it's like if I love the vehicle, the Tesla that they sell. I love it so much. Do I love it at $1 million a car? No. At $80,000 for a Tesla, okay. It's a great car, a lot of innovation. There's value there. There's no value in Tesla at, $1 million a car. The valuation is just too high for me right now for my blood. At someday, in the next 5 years, I think Tesla will grow to a point where they're worth $1 trillion market cap. They're not there yet. They're just overvalued based on intrinsic, I guess they're valuing and paying for growth that are, that's not something, I'm just not comfortable paying for something that hasn't happened yet. I'll pay for a little bit of potential growth, but I don't want to pay for years of growth that haven't happened yet. There's a lot of speculation involved in that. But anyway, so looking at that as an example, if you felt like on a leap, you said instead of buying the equities because they're $1,200 a share, you could spend, I don't know what the price of the options market is right now, I'd have to look, but let's just, for example's sake, you could go buy a leap call a year from now for $100. You spend $100 and control 100 shares of Tesla, $100 a share, and control 100 shares of Tesla a year from now. So anytime you could execute your contract and you'd be able to call on 100 shares of Tesla at set price. So call it $1,200. So anytime in the next year for $100,
you can buy a contract that'll allow you to buy Tesla at $1,200 a share. So if Tesla does moon and go to $2,000 a share, you can take your contract at any time you paid $100 for and go execute, get the shares at $1,200 now, and they're worth $2,000. So you can make $800 a share, which would be a 800% return on the cost of that call option. So call options allow you to control a large amount of shares for a very small amount of price, and your downside is entirely covered. So if Tesla goes from $1,200 a share to $50 a share, your call option is just basically is worthless at that point to execute at $1,200 a share. Why would you when the share price is 50 now? Your max loss is what you pay for the contract, which is, let's say in this case, $100 a share for the contract. So you'd be maxed out on your loss. So calls are a great way to control a lot of shares or be really bullish on a company for a small amount of money, right? That's what's beautiful about call options. You can be bullish on stuff you like. What's really cool is when you go, and if you're super bullish, you'll sell puts on Tesla. You'll use the puts that you sold on Tesla 6 months from now or 9 months from now, that premium you just collected in selling put contracts, agreeing to have Tesla put into your account. Then you go buy leap calls with the premium you got from selling the puts. Now you're double set up to do really well if Tesla, blows up. There's other ways you could do it too. You could, in theory, you could as well, stop loss yourself. You could buy leaps, and then you could also buy some puts to protect yourself. I don't know why you'd want to do that, but I guess in theory you could sell those put contracts if Tesla were to drop and recover the cost of those leap contracts. There's some really cool stuff you can do with options trading to basically control the equities for a lot less and make a greater return on your money, and less losses if you're careful with it too. Okay. Hey, Future Wiz, James says, understanding options hurts my brain. Hurts my brain too. And at least in the beginning it did. That's just how it is. Once you wrap your brain around it, then it's like, okay, you start understanding the language, and you're like, okay, call, put, buy a call, sell a call. Okay, it starts to make sense, and you can think of it in terms that you can understand, and you can get more complicated with some of the more advanced strategies. Options does sound very interesting. Yeah, it is. It's super interesting. I think the best way to start is to find companies you like and just sell puts on them at prices you're comfortable owning the shares at. So instead of going to buy shares in the open market, you just sell puts, and then you get the shares put in your account and you get money for nothing. That's the easiest way. It's like if you don't understand options at all, just sell puts. And on the stuff you already own, just sell calls. Super simple as that. You never need to buy a call. You never need to buy a put, technically. Buying puts would be like insuring your portfolio. Most people don't need to insure their portfolio unless they're highly levered. If you're highly levered, then of course, get out there and buy some puts to protect yourself. I would prefer just to buy the VIX and have that volatility index. Whenever the market goes down, the VIX tends to spike like 600%. So that'd be a good hedge against any major inflationary events. Take 10% of your portfolio and put it into the VIX. And then when it spikes, you're good. You can cover any margin calls that kind of come up. So there's lots of ways to insure your portfolio. But yeah. Marina says, I can't afford to buy real estate in Canada, but I can afford in Colombia. My parents insist not to. Yeah, I mean, it's up to you really at the end of the day. If you can't afford, you gotta maybe tweak the conversation and say, hey, how could I afford to own real estate in Canada? What could I do differently to get a B lender to say yes at 6%? Maybe you can't qualify with an A lender, but there is a B lender or a C lender out there that will lend to you to get you into a deal, and then you can refinance into a better deal. Or you can continue to flip properties until you're in a position where you have enough equity to then qualify for the house that you want to buy and hold. So there's lots of ways to do things, lots of ways to build your income up, and real estate can be something you can get into with very little money, especially if you learn how to JV or partner, or you learn how to talk to some mortgage brokers about B lenders or alternative lenders. Remember, talking to 1 or 2 mortgage brokers is a joke. Like, that's a starting point. You have to talk to 10, 20, 30 different people in the industry. Go out there and talk to people who are funding flippers. You say, hey, how many flippers do you fund a month? If the guy's like, none, wrong lender to be talking to. Maybe they're an A lender. That's what they specialize in. Every broker, every mortgage broker has a different set of clientele and a different set of brokers that they're used to working with, right? So each person has a different situation. So Ram said you can trade options in TFSA. You have to fill out forms to activate options trading on any account. This is true. Ram, however, you are limited what you can do inside of your tax-free savings account or TFSA. I believe you can buy calls. I believe you can sell puts. I don't think you can short. There's certain contracts you can't do. So you can't get in a position where you're over levered or where you're taking an unlimited loss position, I believe, in the TFSA. I'm not actually 100% sure on that. I'll have to follow up on that. I don't do options trading inside of my TFSA right now, so I don't know. My options trading is inside my corp. James says, the thing about the TFSA is if you overtrade, then you are considered a professional, so you can get still taxed. James, I've heard of that. I believe you need to have like an extreme amount of performance in order to be considered in that way a professional. So like if you were getting like a, you know, similar to the S&P 500, like a 20% return in a year, I don't think that they'd come after you. But if you got, you know, you struck gold options trading, then they might come after you and say, hey, your TFSA is like 10x everyone else's. We're considering you're professional, and that some of this is taxable. I don't know. I've heard of that. They're gonna come after any nail that sticks out too far. They'll hammer it down. So I don't know. It might be better to options trade inside of your other accounts, and then use more of your interest-bearing stuff. I find is better than the TFSA. Interest-bearing stuff is at the full taxable rate, whereas capital gains are half tax-free. So I prefer to be doing my options trading in a taxed account because it is tax advantaged, right? If you do consider options trading active, which I do inside of my corp, then I have deductions against that, and it's an active business, so it'd be the first $500,000 of income is taxed at 13% or thereabouts. I'm not an expert on that. Talk to your accountant, but that's my understanding. Is that there are some advantages to having it inside of a corp as opposed to having it inside your TFSA. But yeah. Can you recommend YouTubers to learn more about options trading? Tasty Trade. So if you go just Google Tasty Trade, take their free online options course. That's a good place to start. If you want a Canadian course to pay for, Irwin has the stock hacker stuff, and it's good. I have a referral thing for it. So if you want to do that, hit me up, or don't, just go check his out too. It's a Canadian version, and they hold your hand all the way through, so it's pretty good too. Did this just start? No, this did not just start. Killed it on Twilio today. Nice. Sam says, with 52,000 employment income, I qualify for a mortgage of only 210,000. Is it worth getting into real estate, or will it tie me to one location and headache? Better S&P 500. So Sam, it really depends on your long-term goals, right? So, you know, and one side, if you're going to be living in a location for a few years, it can make a lot of sense to get into a property where you can have another unit in the property you can rent out. You can be what's called a house hack, so you're living for free, and then you're building some equity through mortgage pay down. Maybe it's an appreciation. Maybe you buy smart and you add a little bit of value to the property by making some strategic changes to the property. Could be paint, could be floors, could be something simple like that. Could be even just decorating it differently. Can add a big impact and make you a good amount of money because you're buying, say, 20% down, then you're 5-to-1 levered. So if you unlock $50,000 in the value of the home, then that could translate, if you put $100,000 down on the property as your down payment, that could translate to a 50% return on investment, which is fantastic. The leverage makes it, you know, advantageous, I think, to own. There are situations where it makes sense to rent instead and just invest in the S&P 500. It depends on your goals. If you want to be traveling and, you know, enjoying life, I'm at a stage right now where I just want to be flipping and investing in, you know, options trading and doing other businesses. I don't want to own any real estate. So I'm disposing of my real estate portfolio, albeit slowly. I still have, you know, a couple of duplexes and triplexes and stuff that I need to get rid of. Hit me up, by the way, if you're looking for a property in London, Ontario. I am selling right now. I have 12 properties still going up for sale. We sold 3 or 4 off, but I'm selling more. I have some flips coming up too in January that'll be selling. So hit me up if you're interested in my buy and hold portfolio or whatever. I got, you know, 2 that are getting out of. There is, you know, value to doing it, but I just value my time at $1,000 an hour. So every time a tenant threatens me or calls me or goes around my property manager and finds me and messages me, that already has destroyed my cash flow for the month in my head, because I've spent now my mind space. So the cash flow that I made on that property is equivalent to less than 0 to me, because I've now spent time on that property. Whereas with the options trading, I can spend 5 minutes, or I can spend 0. But if a tenant's crying because there's a water leak, or they're crying because of whatever, and the property manager isn't dealing with that, or they are dealing with it and the property manager is bringing it to me, that's time that I now have to spend. So for me, it just doesn't make sense. I'm too wealthy to be owning small properties. So I'm getting rid of my small property portfolio. I may invest in, you know, larger projects where it can make sense, where I have an active partner on the ground, where there's good property management, and it's done to scale so that, you know, there's no involvement of me on boots on the ground dealing with tenants. That's something I want to avoid and get out of. So that's part of my shift. But if you're still early in your journey, let's say you have less than a few million net worth, it can make a lot of sense, I think, to, even if you're just starting out 100 grand or 200 grand, you're thinking, where do I invest that money? Real estate's a great way to take 200,000 and turn it into $1 million. You got to put the time in, you got to grind it, you got to be dealing with the headaches with the properties, you got to be fixing them up. That whole business, because real estate's a business, is a great business, and you can make a lot of money, and it can take you to millionaire status. A lot of people become millionaires through real estate. The majority of Canadians become millionaires through real estate, but it's not the way to become a billionaire, and it's not a great use of time unless you wanted to build a business around it and scale it, which I just don't, and I find it hard to do with the smaller properties. So my portfolio now, I've outgrown it, and it's time for someone else to take on the portfolio and to buy the properties off. And so I've been selling those off. So if you know anyone who's looking, hit me up. I'm not actively trying to sell them that hard. I don't even have them on MLS. I probably should clean them up and get them, photos taken and, proper 3D tours and write a nice description and put it on MLS, and they'll sell. It's just the time to do that. It's a lot of work to get these properties ready for sale. So if I can not do the work, that'd be cool. I'd be cool to sell with a little discount to not have to do anything. That'd be a win. So hit me up if we can make a win-win. If you were to live somewhere else, are there any places you have in mind? Ram, some are warm. Some are warm where the culture is friendly and slow, and there's a tax haven treaty set up so that I pay very little tax. So I don't know, you can draw a Venn diagram, but safe too, like super, super safe for my kids. Language doesn't matter that much to me, really. Yeah, so I don't know. There's a short list of countries that I have kind of in my brain here that I'm thinking about, but buy Zillow houses. There you go. So Matthew jumps in and says buy Zillow. So Zillow, I actually nibbled on a little bit of Zillow today. I sold some puts on it, so I might get assigned Zillow at $45 a share. Today it was crashing at $67 a share, and I was like, geez, I don't really want to own at $67 a share. I'm afraid to buy the equity. Who knows how much lower it'll go? But I'll sell some puts at 45. So worst case scenario, I might get shares of Zillow put in my account. I think it was 65 cents a contract. So I get like at 44, so $45 minus 65 cents in contract premium I got. At $44 a share for Zillow, I might get assigned the next month. If it stays above that, then I got money for nothing. Today the market was freaking out. So I was like, hey, I might as well take advantage of the market's panic. Zillow's, dropped like 30% on their share price. They closed down their house flipping division. They didn't do a very good job of, they realized that it's very hard to automate the buying and selling of real estate. There's a human element. They couldn't even find enough people to renovate their projects. I learned that example the hard way in 2019. We took on 50 projects. It was way too much. We had backlogs upon backlogs. It was just too much, too fast. Scaling a real estate business is difficult. Even Zillow couldn't do it. But I'm bullish on Zillow. I like a lot of the other stuff that they're doing, not the house flipping division they've closed and the quarter of employees they've let go, but the other stuff they're doing is pretty great. So I think there's still some intrinsic value there. I think, it'll stay above 45. We'll see. We'll see. Worst case scenario, I'll roll my way out of it. So if I were to get assigned, getting close to assignment date and it's getting close down to 45, let's say a month from now, Zillow is at 45. We'll see. We'll watch and see. Then I would just start selling calls on it. And when I get assigned, I would get the shares called away. So I might sell calls on it at 40, and then I might pay a $7 premium. So I get my shares called away at 47. The reason I would do that is so if the shares drop further down to 40, my shares still get called away. So I sell a call lower than the current price. That way my shares get called away no matter what. Even if the price drops further, my shares still get called away. And then I don't have to worry about holding this equity bag on Zillow. But yeah, lots of ways you can handle it. Mike, what Delta puts and covered calls do you usually sell? Am I really looking at Delta? No, Kron, I'm not really looking at Delta. I don't really trade based on specific Delta. But yeah, I eyeball everything. So for me, my starting place is like looking at companies that I like, quality companies. There is some tech stuff that does have an inherent amount of risk with it. So there are better premiums being paid for the contracts. But for me, it's about buying when the company is being beat up. When the market is most fearful about a company. So Blizzard today, Activision, was down like 16% at the peak. I like Activision. I like what they're doing. I like their gaming stuff. I wouldn't mind owning shares at a 30% drop from current price. That for me would be fine. So I might sell puts at that. I know the premiums aren't as good. I know that I'm way far out. A lot of people sell right at the strike, right at the money. I'm way far out of the money. I would much rather get a lower annualized return and then be able to close that contract out 2 weeks from now for 60% of the profit and not wait for it to expire. I just prefer to take a little bit less risk, especially after what happened to me in the summer. I'm taking a lot less risk now, but I am looking, yeah, for the companies that I like, that are on my portfolio. So I'm not necessarily just looking for delta or just, chasing premium alone. It's not just premium that I'm chasing. It's looking at companies that I like. Moreover, it is about, whether there's distress or a bit of blood in the water, typically. Selling puts on a company you'd love to own at a cheap price is something people overlook constantly. Great point. Yeah, I mean, thank you for the comment. I think that a lot of people, even I think a lot of people just are waiting to buy these equities and they're like, oh, I'm just going to wait for the price to drop to whatever. No, like just start selling puts on it. If you want it that price, you get paid something. Just write the contract. If it's never going to happen, okay, money for nothing. If you think the stock will never drop that low, fine, you get money for nothing. That's cool. Hey, is private jet still happening? Yeah, it's on my to-do list for next year for sure, to get a private jet, and maybe the first quarter of next year to do some sort of trip. There's some really cool stuff you can do with filling up one-way flights. You can take one-way private jet flights for much cheaper than round trips. So just going somewhere like, I don't know yet, we'll see. But I understand that there's no long COVID tests and lineups and all that. You literally get onto the tarmac out of your private limo that picks you up, and you get onto your private plane and you go. It's just nice not having any restrictions. It's the way I want to fly in the future. So yeah, it'd be a really cool trip to do. I think being able to amortize that cost over, say 15 people on a private plane would be much better. And make it more affordable, more palatable. Did you make a video about how you did a 9-day flip? Alex, that was a long time ago, the 9-day flip. Maybe years and years ago. And I had a good crew of people come in and we turned the whole place around in 9 days. I've had flips that have gone a year, longer. Bad contractors run into stuff. City of London, wants you to submit drawings. They take 45 days to review them. The city inspectors don't come out for a month. During COVID, I had one that went almost a year and a half, just in delays, waiting for materials, contractors, the city to come in and approve things. Number of delays. So I've had everything happen. For a 9-day flip to happen, it's got to be all cosmetic. It's got to be like floors, paint, cabinets, like taking your kitchen, putting a new kitchen in, painting, all new floors, that windows, like that kind of stuff, super quick. You can get in and out. If you've pre-ordered the windows, 90 days, let's say it's a 90-day closing, and on the day you put the offer in, you've already got your window order in. So by the day of closing, you have all your materials ready to go. You've planned it all out. You've got all your trades lined up 3-4 weeks before you close. Each person with their task ready to go, and then a backup in case that person doesn't show, because they never will. There'll always be someone who won't show, and then because the painter didn't show, then your flooring guy's delayed because you can't lay your floors until your painting is done, or they get paint your floors. Just stuff like that. You gotta have a really good plan laid out. There was a time where I was sharp, and I could argue for $5 a sheet of drywall. I was good at finding all the deals on materials, and I had a good lineup of contractors. Today, it's hard to find affordable labor. Everyone's slammed. All the contractors are busy. No one wants to prioritize you. It's hard to get cheap materials with the supply chain issues that we're having right now. Just lucky to find any material at all. It's a different environment we live in now, so it's harder to do it as cost effectively as I once did. And the biggest issue is I have 3 young kids now. It's so hard for me to get anything done with 3 young kids. And my wife demands things of me, and I currently have my mom living with us, and my dad is like, basically I'm helping support him too. So it's just, I have a lot of drains right now that make it very hard for me to be that efficient. So I probably couldn't do a video on a 9-day flip anymore. It would take the amount of effort and energy it takes to pull that off. I have too many other things going on. I probably couldn't do it. But yeah, you totally could if you had all the things lined up again. I've done it. It's been done. This was like back when I had one child, when she was young, and it was different. It was a different time. So is it doable? Yes. Do I want to do a video on it now? No. Have I done a video on it? I think so. I think somewhere on my channel. I might have deleted it, but there was a video where I did that. Yeah. Someone says, I'm getting involved in larger scale real estate firms, but obviously compensation doesn't work out to the path you followed. Yeah, I mean, I have no interest. Someone offered me a job right now. I was like, hey, Mike, I want you to take a job, make $3 million a year, be a CEO of like whatever company. The answer is no. Like, I don't want to work at a job for $3 million a year. So if you give whatever the business is, if it requires me to do it as a full-time job, that's slavery. And it's slavery for really good money, golden handcuffs, but like, not interested. My freedom to me is way more important than money. Part of why I'm selling the real estate portfolio off is because, part-time, it takes up my time. Tristan said you can buy calls and puts and sell calls if you have the shares already in your TFSA. Okay, there you go. I didn't know that. I haven't fact checked that, so I'll trust Tristan on this one. Ram says, would you recommend getting experience at multifamily firm like York Property Management in London, Ontario first? I mean, you could, I guess, work for a property management company to learn property management, but I don't know. Yes, you could. You could also just buy a property and learn through the School of Hard Knocks. That was how I learned everything, including the trades. Was just from spending 10,000 hours around contractors and learning. YouTube and Google and the building code are fantastic resources. Josh has just picked up my 5th burb and watching your stream since the first. Wisdom is much appreciated. Thanks. That's awesome. I've been doing this for like 3-4 years now, so I appreciate the following. Sam says, yes, I want to travel to optimize work income. There you go. So if you're going to buy a property, make sure that you have good management systems set up. And don't scale a lot of properties, buy like one property. Shazia says, would you help me pick a rental property that I can add value to make instant equity and eventually rent out? No, I'm not a realtor. I am a realtor, but I'm not a realtor that can be hired for public. That you'd want to find a good realtor who'd be able to help you do that. If I get assigned, I just sell and roll out. Don't like the wheel as much as naked puts right now. Yeah, I mean, that's one way. You could just sell or roll it out. So if you're about to get assigned your put, you could just basically buy to close the current put that you sold and then sell another one, and the premium on the new one you just sold will cover, and you're in a positive position. You don't have to use up all your equity to then get assigned. You don't have to tie up all your cash in this new equity position. You can continue to roll it out and save your leverage. So that is an option too, is just rolling things out. Tristan says, I do it on Quest Trade since it's a covered call. There's no margin risk for the broker. There you go. Cool. That makes a lot of sense. I think covered calls would make a lot of sense. No risk. Everyone should sell covered calls in their portfolio, especially if it's just like non-growth stocks, like just dividend. If you have a dividend portfolio, every dividend portfolio, and I love dividend portfolios, by the way, but every dividend portfolio, you should just sell calls on the entire portfolio because it's free money. Like even if you sold the calls way out on like, you pick days where the stock's doing really well, where there's a big green day for the stock, and you sell stuff another 10% out of the money, okay, like worst case scenario, you get all that dividends and you have to sell the stock for 10, 15% more profit. But most of the time, that never ends up being realized, and you end up getting money for nothing. Like the contract almost always, if you sell it that far out on a up day, your shares almost never get called away. So you have to keep your shares, keep collecting dividends, and you're getting a stream of income from selling covered calls on your existing portfolio with no downside, because the worst case is your own shares get called away and you just buy your shares back again. So it's basically a free income stream of about 1% a month. So that's how you juice up your dividend portfolio, is like a dividend portfolio that was acquired using puts. So you got the acquisition of all these companies at 2 to 5% discounts. Then you collect all the dividends and you sell covered calls for another 1% a month premium on that portfolio. That's the dividend wheel, is what I call it. I love the dividend wheel. My other portfolio consists just of quality dividend companies. And that portfolio year to date is up almost 7 figures. No, not quite that much. Almost. Very close to 7 figures in that portfolio. It's done very well for me. My other options trading portfolio that I've segmented that has caused me to not be able to shave is resulting to some crazy, stupid meme and tech plays that I got involved in, which I'll never do again. Stay away from that stuff. Do only define shorting. I think I threw all the questions today. Mike, if you move, I won't be able to buy more of your crypto miners. Yeah, well, I'm years from moving, don't worry. I just moved into this house like a few months ago. So I have a time horizon where I'll be in Canada, and for the foreseeable future, at least the next 4 or 5 months, 4 or 5 years, I'll be here. And well, we'll see. You never know. But I'll be back in Canada anyway for like almost half the year as a non-tax resident. I just have to stay less than 6 months in Canada. So I'll probably still have a house that I keep in someone else's name that I come and visit, and probably still a little mining operation or something. I don't know. We'll see. We'll see. But I think I'll probably come back, at least maybe I'll just rent a house for the summer, come back to Canada. I'll probably still be here for the foreseeable future. My family and friends are here. So if I leave, it'll be for tax reasons and for getting out for the winter. So thank you everyone for coming. And the last question was, how do you stay motivated to work so hard like before you had kids? Well, I grew up with nothing. So for me, it's very easy to not want to have nothing. I know what that feels like. And now it's just about, it's hard. I gotta admit, it's hard. It's just part of my DNA now that I continue to work. But it is hard to put long hours in when you don't need the money, when there isn't that, the same incentive. But I always try just to frame it as if like, I am poor. I pretend that I'm broke again. Or I keep no cash on my account so that I'm forced to feel hungry. So that's one way to do it. But, all right, everyone, I'm going to wrap it up. It's been a great stream. Thank you, everyone, for watching. The secret to unlocking a wealthier you is 3 levers in your control. Spend less, earn more, and maximize returns on the difference between what you're earning and what you're spending. So maximizing the returns becomes the most important once you've built up that portfolio of, let's say, as soon as you start to get close to 7 figures, it becomes more important what you're investing in than how much you can save. So frugality is a cornerstone of financial independence, but it's less important as you can build up that income and build up that net worth. So if you don't like frugality and you're watching this, you're like, Mike, I hate frugality. Too bad, suck it up. But if you want to get out of the frugality stage, you got to be frugal for a while. You got to save a lot more than you're spending. You can't spend all of what you earn, or you're never going to get ahead. So you got to sacrifice for a little bit, and then you can get away from the frugality because it's, I guess you're always sort of frugal in a way, but being frugal when you have $2 million in income is a lot different than being frugal when you have $40,000 in income, right? You're even at 50% savings rate with that high income, you can live pretty lavish. It might be considered frugal compared to your earnings, but yeah. So anyway, that's my little rant for today. Thank you everyone for watching. We'll see you on Instagram. I'm Mike Rosehart. And as always in the comments, drop a comment and I try to read all the comments. So yeah, feel free to drop one. And if you're watching the replay, say hi, drop a comment and let me know you're watching it. It's cool to let me know that you're actually, someone actually watches these, actually care. So thank you so much, everyone, and we'll see you next Wednesday. Maybe by next Wednesday, I'll be up 100 grand. I can shave this off.